All right, so while Toronto and Calgary were getting absolutely hammered in 2025, something completely different was happening right here in Greater Moncton. And look, I know this is a hyper local market deep dive into my New Brunswick market, but what happened here over the last 6 months is exactly why affordable markets are going to be the real winners in Canadian real estate. If you think that data from a 150,000 person city doesn't matter, please stick around because this story might change how you think about Canadian real estate. Hey everyone, Cameron here. This is our half year review slash deep dive into the Greater Moncton real estate market. And yes, I know that this will be a super local deep dive explaining Moncton content, but here's the thing. While everyone has been watching the big markets, looking at the big headlines, we were quietly having one of the most interesting 6 months. From January through June 2025, the data from CREA shows us a different story. And I think that everyone curious about Moncton real estate needs to hear this. Coming into 2025, the Bank of Canada had basically nuked the housing market with interest rate hikes. Toronto was down 2.5% year over year. Calgary dropped 3.6%, and inventory was exploding everywhere. Toronto's listings were up 23%, while Calgary's seemed to double. Not ideal. Here's the thing about Moncton. We've got a massive affordability advantage that just doesn't exist in bigger markets. Toronto's median home price at the time of recording is about $1.1 million, and Calgary is a hair over $585,000, and here in Moncton, we're sitting around $350,000. That's not just a price difference, that's a difference between being in a bubble and building a sustainable market. When your average home costs a third of what it does in Toronto, you're not dealing with the same speculative pressures. You're dealing with real buyers making real decisions about real homes they can actually afford. Now, to understand 2025, you need to know what happened before. Obviously, COVID. We had a massive influx of people moving to Atlantic Canada, specifically New Brunswick, and we hit a 50-year population spike that was wild. We saw nearly 15,000 new immigrants, plus people moving here from other provinces. Moncton seemed to be the biggest beneficiary because we're bilingual, we've got jobs and housing. Well, you've heard me say it, it's affordable. But by 2024, that migration wave seemed to normalize. We went from gaining about 600 people from other provinces to actually losing about 300 from reports published earlier this year. The pandemic rush seems to be over. We're a few minutes in, so I want to share the data from CREA on what happened here in Greater Moncton last month. So June brought us 334 transactions with a hair over $130 million in sales volume, and the median price is sitting at $373,500. The days on market is 32.5, and inventory is at 4.2 months. Sales to new listing ratio is at 59.6, and that's bordering on seller's market territory. So what we're seeing here is a new equilibrium, not the 15-day selling frenzy of 2021, but not the sluggish 57 days we saw in January. We're having normal market cycles throughout the year. Wild, I know. And remember, while this is happening in Moncton, Toronto's listings are up 23% and Calgary's have doubled. We're definitely moving against the national trend here. Since I have never been one to make predictions, I'm going to spend the next few minutes going back and looking at the data from the last few months. January, obviously, this is where the story began for the year. We had 179 sales and $68.6 million in sales volume, and the median price was $350,000. But the key here is that it took almost 2 months to sell a house at 57 days on market. Our inventory, well, we had 4.8 months of supply, and anything over 4 months is technically a buyer's market. February, we did start to see some improvement. Sales were at 199 units with $72.5 million in sales volume. Median price, it was the same as last month. Days on market dropped to 35, and inventory was at 4.6 months. What's happening? I think buyers were starting to accept that rates probably weren't going much higher, and some of the people that were sitting on the sidelines actually started to plan and make their move. March is where things get interesting. Sales were at 247 units, and median price jumped to $370,000. That's a great spike for 1 month. Here's what I think is happening. The cheaper inventory was getting bought up, and what was left was higher end, higher priced properties. So when volume drops but prices rise, it usually means that there's less market sensitivity to these higher priced properties, and those with the equity seem to be making their move. So hats off to Shantanu Duda, my university economics professor. I hope that I conveyed the concept of supply and demand accurately. Days on market was at 33 days, and the sales to new listings ratio was at 48%. Some might say that this is textbook balanced market territory. But that price jump, was it foreshadowing? April showed that the spring market was waking up with 308 transactions and just over $114 million of sales volume, and the median price pulled back slightly to $348,000. What do we see? Well, it appeared that some lower priced properties were hitting the market and getting bought up. The days in market improved to 30.5 days, and inventory dropped to 3.9 months. Spring energy was building, but we weren't seeing the craziness of previous years. May is when everything seemed to click in our spring market. We had 367 transactions and $142.5 million, which was our strongest sales month of the year. Median price was at $356,550, and days on market again was at 33. But the story, I think, was in our dropping inventory, where we saw 3.6 months of available properties. For the first time all year, we were below 4 months of supply, and we were officially transitioning from what some might call a buyer's to a seller's market territory, or we were teetering in the balanced zone, depending on price point. A big impact across Canada is household debt. Canadians are carrying debt to income ratios of 174%, and it's at an all-time high. Here in Atlantic Canada, 49% of people are $200 or less away from being able to pay their bills. That means they're using credit cards or lines of credit to be able to cover some of those monthly expenses. This debt burden was an inevitable force shaping our market across Canada. Even with relatively affordable prices, buyers were still making more careful decisions, taking longer to decide, and really stretching their budgets. It's why our market moved more gradually than in previous years and previous market cycles. So, what does the 6-month journey tell us about this year? First, affordable markets can be resilient. While expensive markets get crushed, we maintain steady growth, showing about 3% year-over-year price appreciation in our market. Second, we saw a complete market cycle in 6 months. From buyer's territory in January through to seller's territory in June typically takes longer. Third, the new normal isn't the new normal. We're not going back to the 15-day sales and bidding wars on everything that we saw during COVID. The new equilibrium is 30 to 35 days on market with some competition, but reasonable growth. If you're thinking about buying in Greater Moncton, here's what the last 6 months is telling us. We're still one of the most affordable markets in Canada, but the easy opportunities of early 2025 are gone. You'll face some competition, especially below $300,000, and you're not dealing with the same competition and craziness at that lower price point that you would see in bigger markets. If you're looking for a possible deal, you might want to hone in on properties that have been listed for more than 40 days or so. For sellers, the message is simple, and I think you've heard me say it every month. Price your property right from day one. The days of listing high and getting bidding wars to drive the price up and over asking are gone. But if you price it competitively, you can still expect to sell quickly. In Greater Moncton, the best opportunities seem to be below $350,000. And trade-up buyers between $450,000 and $550,000, that market is alive and well, or at least that's what's been keeping me busy with potential buyers that have a lot of equity in their starter home and they're looking to trade up. If you are in one of the situations with equity in your home, you've been there for a while, it doesn't fit, I do have a cool guide linked down in the description, and you can see how that equity could work for you. This isn't a prediction, but based on the data, I expect Greater Moncton to keep on this pattern of steady, sustainable growth. We're not immune to the national trends, but our affordability advantage gives us resilience that expensive markets simply don't have. You'll want to watch interest rates, immigration numbers, and whether interprovincial migration picks up again. Thanks for sticking with me. 6 months show the Greater Moncton is writing its own real estate story, And yes, this was a deep dive into our local market, but the lessons apply to affordable markets across Canada. If you found this video helpful, please hit that like button. It helps the channel grow and others find this content. If you're thinking about buying or selling in the Greater Moncton area, I would love to connect. The market may have found its new normal, but there are still great opportunities out there. You just have to know where to look. What do you think about these trends? Let me know in the comments down below. Thanks for watching, and I will see you in the next video.